Once the golden child of Singapore's REIT scene, Keppel DC REIT soared to all-time highs, driven by the booming demand for data centers. But fast forward to today, its share price has taken a steep dive from its peak. So what happened? Is this just market noise or a deeper signal of shifting fundamentals? In this video, we'll break down the reasons behind Keppel DC REIT's decline, what it means for investors, and whether this drop presents a danger sign or a buying opportunity in disguise. Since peaking, Keppel DC REIT's share price has pulled back. Here's what's behind the decline. First, a tenant default hit performance. In December 2023, the REIT issued a letter of demand to a tenant in China for roughly 48 million renminbi, about 9.1 million Singapore dollars, in unpaid rent and charges. That property contributed around 8.5% to its Q3 2023 gross revenue, and the missed payment could shave approximately 0.655 cents off FI 2023 DPU, equating to a 6.4% hit to full-year distributions. Second, there's a slip in occupancy. As of end 2024, occupancy slowed slightly from 98.3% to 97.2%, as some properties in Amsterdam, Gore Hill, and Singapore experienced lower utilization. Third, structural concerns linger despite the upside. While the REIT has delivered solid DPU growth and strong renter reversions, enabled by smart acquisitions and active asset management, it continues to face risks such as short land leases in Singapore and high tenant concentration. In short, tenant credit risk, modestly lower occupancy, and structural vulnerabilities like lease tenures and tenant reliance have weighed on investor confidence and contributed to the share price easing off from its highs. Keppel DC REIT is Asia's first pure-play data center real estate investment trust, listed on the SGX since December 2014. As of mid-2025, it owns a portfolio of 23 high-quality data center assets across 9 cities in Asia-Pacific and Europe, including Singapore, Australia, Malaysia, Ireland, the Netherlands, Germany, the UK, and China. Collectively, these assets span over 2.5 million square feet of lettable area, with total assets under management of approximately 5.0 billion Singapore dollars. The REIT's flagship properties include Keppel DC Singapore 1, 2, and 5, Dublin 1 in Ireland, and DC Frankfurt 1 in Germany, all located in strategic digital hubs with strong demand for hyperscale and colocation services. Singapore remains a core market, accounting for roughly 50% of its AUM and over half of its net property income, reinforcing the REIT's dominant presence in the region's digital infrastructure landscape. As at June 30, 2025, the portfolio maintained a healthy committed occupancy rate of 97.2% and a Wale of 7.7 years, among the longest in the SREIT sector, supporting stable and visible cash flows. Keppel DC REIT strategy is anchored on accretive acquisitions, proactive asset management, and capital recycling, all aimed at delivering long-term sustainable distributions and capital growth for unit holders, as global demand for data infrastructure continues to surge in the digital economy. As of 2025, Keppel DC REIT's portfolio is fully concentrated in a single high-growth segment, data centers, making it the only pure-play data center REIT listed on the SGX. These assets are strategically split between 2 key categories: co-location and fully fitted data centers, which make up around 76% of the portfolio, serve enterprise clients and hyperscalers with high-performance computing needs. The remaining 24% consists of shell and core assets, leased on a long-term basis to specialized data center operators who handle the interior fit-outs and tenant management themselves. Geographically, Keppel DC REIT maintains a well-diversified international footprint. Singapore remains the anchor, contributing about 50% of total assets under management and net property income, with flagship assets like Keppel DC Singapore 1, 2, and 5. Europe accounts for over 40% of the portfolio, with properties across Ireland, the Netherlands, Germany, and the UK, tapping into strong demand from cloud providers and fintech ecosystems. The remaining 10% includes assets in Australia, Malaysia, and China, further reinforcing the REIT's global digital infrastructure reach. This regional spread not only diversifies currency and market risks, but also positions the REIT to benefit from rising data consumption trends across developed digital economies. Let's dive into Keppel DC REIT's property asset detail breakdown by country in 2024, visualized right here in this chart. Starting with home base, Singapore. Singapore forms the bedrock of the portfolio, contributing a dominant 1.85 billion Singapore dollars, or 50% of total asset value. The REIT owns 8 operational data centers here, including Keppel DC Singapore 1 and 2, both in Serangoon North, fully leased to global cloud and IT service giants. Singapore 5, a state-of-the-art greenfield development in Jurong, valued at 300 million Singapore dollars, renowned for its high power density and sustainability. Other long-term income contributors include Singapore 3, Singapore 10, and a co-owned facility with Digital Realty Trust. Moving to Europe, which makes up a substantial 40% of the portfolio, Keppel DC REIT has secured key assets in leading digital economies. In Ireland, the fully leased Dublin 1 and 2 serve hyperscalers and telecom clients, bringing in 600 million Singapore dollars in combined value. The Netherlands' Almere data center, valued at 400 million Singapore dollars, benefits from strong government and tech demand. Germany's Frankfurt DC 1, worth 350 million Singapore dollars, supports co-location services in Europe's financial nerve center. And in the UK, the Cardiff data center adds 130 million Singapore dollars in GBP-denominated revenue, contributing both income and currency diversification. Globe showing Asia Australia lastly, the remaining 10%, or about 370 million Singapore dollars, is spread across Australia, Malaysia, and China. In Malaysia, the Cyberjaya facility, a shell and core asset worth around 100 million Singapore dollars, is located in a rising digital corridor. And in China, the Guangdong asset, valued at 85 million Singapore dollars, has faced tenant default issues in late 2023, a situation closely watched by investors. Altogether, this globally diversified portfolio ensures Keppel DC REIT captures resilient income across multiple geographies, balancing growth from digital infrastructure with regional risk management. When it comes to data center REITs, regional market share plays a critical role in driving valuation, tenant mix, and income resilience. Let's break down the landscape in 2024. Keppel DC REIT leads the pack in Asia-Pacific with a dominant presence in Singapore, Malaysia, Australia, and China, collectively accounting for over 60% of its net property income. Among Asia-listed REITs, Keppel DC is the undisputed leader, being the first and only pure-play data center REIT listed in Singapore. Its strategic location in high-connectivity cities like Singapore and Sydney gives an edge in latency-sensitive industries, like finance and cloud services. In Europe, Keppel DC REIT holds competitive but smaller share, with about 40% of its AUM allocated to properties in Ireland, Netherlands, Germany, and the UK. While it competes against global giants like Equinix and Digital Realty, Keppel DC's long-weighted average lease expiry, Wale, and mission-critical locations, such as Dublin, Frankfurt, and Cardiff, allow it to punch above its weight and secure stable euro and pound-denominated rental income. Keppel DC REIT currently has no direct exposure to North America, the world's largest and most competitive data center market dominated by U.S.-listed giants like Equinix, EQIX, Digital Realty Trust DLR, and QTS Realty. However, this also means the REIT is less exposed to aggressive pricing pressures and supply-side competition that's prevalent in the U.S. Keppel DC REIT's Asia-Europe concentration gives a unique strategic position. It benefits from rising digital adoption in Asia-Pacific, gains currency diversification in Europe, while avoiding the saturation risks in the U.S. market. This well-balanced geographic mix supports its long-term vision to be a stable pan-regional data center REIT, offering both yield and growth potential to investors. Here's a snapshot of Keppel DC REIT's latest financial performance, comparing its trailing 12-month results with FY 2024 and FY 2023. Revenue came in at $295 million, a modest 3.6% decline from FY 2024, largely due to tenant issues in China and temporary vacancy in select European assets. Net property income also dipped slightly to 260 million Singapore dollars, though it remains above FI 2023 levels, reflecting steady core operations. Distributable income held firm at $181 million, with only a minor drop versus FI 2024. DPU stayed stable at around 9.40 cents, offering investors consistent yield despite macroeconomic headwinds. Margins remain healthy, with a net profit margin above 60%, while gearing ticked up slightly to 37.1%, still well within the MAS regulatory cap of 50%. Earnings per unit stood flat at 0.093 Singapore dollars, and the share price has stabilized around 1 Singapore dollar and 28 cents, a far cry from its 2021 peak of 1 Singapore dollar and 82 cents, but reflective of the sector-wide repricing due to rising interest rates. Market interest remains resilient, with daily trading volumes averaging 3.5 million units, showing that institutional and retail investors continue to stay engaged. Overall, the numbers show a REIT that's holding steady despite tenant risks and rising funding costs, thanks to its long Wale, mission-critical assets, and high occupancy rates. Here's a 4-year snapshot of Keppel DC REIT's financial performance. Gross revenue grew steadily from 200.9 million Singapore dollars in 2021 to 306.6 million Singapore dollars in 2024, reflecting the REIT's expansion across Asia-Pacific and Europe, as well as positive rental escalations. Net property income, NPI, followed suit, rising from 184.7 million Singapore dollars to 270.8 million Singapore dollars, with NPI margins consistently above 88%, underscoring excellent cost efficiency and asset performance. Distributable income also saw stable growth, reaching 183.9 million Singapore dollars in FI 2024, up from 163.5 million Singapore dollars in FI 2021, despite headwind from tenant defaults and elevated interest costs. DPU increased incrementally from 9.17 cents to 9.49 cents, supporting income stability for unitholders. The payout ratio remained high, typically around 85 to 90%, striking a balance between consistent distributions and capital retention. Importantly, revenue growth rebounded sharply in 2023 with a plus 24.5% increase, before moderating to plus 10.6% in 2024. In summary, Keppel DC REIT has delivered resilient financial growth, strong cost discipline, and reliable income, backed by its mission-critical data center portfolio across key global markets. Let's take a closer look at Keppel DC REIT's valuation metrics over the past 4 years. Starting with the price-to-book ratio, we see that Keppel DC REIT was trading at a substantial premium in 2021, around 1.81 times NAV, reflecting investor confidence in the data center boom. But since then, the PB ratio has steadily declined, 1.45 in 2022, 1.10 in 2023, and now sits just above book at 1.02 in 2024. This suggests that the REIT is now trading close to its net asset value, possibly signaling a return to fair valuation or reflecting investor caution around rising rates and tenant risks. In terms of net asset value, Keppel DC REIT saw a steady growth from 1 Singapore dollar and 17 cents in 2021 to 1 Singapore dollar and 29 cents in 2023, before easing slightly to 1 Singapore dollar and 26 cents in 2024, likely due to revaluation adjustments and FX headwinds in its overseas portfolio. On the income front, dividend yield has become more attractive, 5.06% in 2021, rising to 7.25% in 2023, and reaching 7.41% in 2024, driven largely by the decline in unit price from its 2021 highs. The price-to-FFO ratio, a key metric for REIT valuation, was not disclosed publicly, but the falling PB ratio and rising yield suggest greater relative value for long-term income investors. In summary, Keppel DC REIT's valuation has normalized from its pandemic-era premium, while yields have improved and NAV remains solid. For investors seeking exposure to digital infrastructure with stable cash flows, this REIT may now offer a compelling mix of income and value. Let's examine the income performance of Keppel DC REIT from 2021 through 2024, focusing on 2 critical indicators. funds from operations FFO, and the interest coverage ratio. Starting with FFO, which reflects the REIT's recurring operating cash flow. In 2021, FFO stood at approximately 154.6 million Singapore dollars. This grew steadily to 172.9 million Singapore dollars by FY 2023, backed by rising rental income and acquisitions. As of 2024's trailing 12 months, FFO came in around 168.5 million Singapore dollars, showing slight moderation due to tenant default issues and higher operating expenses in Europe and China. Next, we look at the interest coverage ratio, a key gauge of the REIT's ability to service debt. Keppel DC REIT maintained a very strong ratio of 11.0 times in 2021, reflecting its low gearing and strong EBITDA base. However, with rising global interest rates, the ratio gradually declined to 7.5 times in 2023 and further to 5.3 times by mid-2024. While lower, this still indicates healthy coverage and prudent debt management relative to the SREIT average, which tend to hover around 4.5 times. In summary, despite some softening in recent FFO and narrowing interest coverage, Keppel DC REIT continues to generate robust cash flow and maintain solid financial discipline, a reassuring sign for income-focused investors. In 2024, Keppel DC REIT's global data center portfolio shows strong performance across core markets. In Singapore, all four main assets are near or fully occupied. Singapore 1 and 2 are fully leased to hyperscale and enterprise clients. Singapore 5 holds 97.8% occupancy, and Singapore 10 exceeds 96%. In Australia, Sydney's Gore Hill is fully occupied, underscoring APAC demand. In Europe, Dublin 1 and 2 are at 98.5% and 96.7%. Almere, Netherlands, is over 94%, and Frankfurt DC 1 is at 92% due to temporary optimization. The UK's Cardiff facility is 98% occupied with long-term GBP leases, while Malaysia's Cyberjaya is fully leased under master terms. The exception is China's Guangdong DC, where a tenant default in late 2023 cut occupancy to zero, now under legal recovery. Overall, the REIT's high occupancy in strategic hubs supports stable income and highlights the mission-critical nature of its assets. Keppel DC REIT boasts a strong lease profile, with a portfolio WALE of about 7.7 years, well above the SREIT average. Co-location data centers, mainly in Singapore, Ireland, and Australia, hold a WALE of 7.8 years, offering long-term income visibility. Shell and core facilities go even further at 8.3 years, mostly on triple-net leases that deliver stable, inflation-hedged income with minimal capex. Recent rental reversions remain positive in key markets. Singapore renewals posted low single-digit gains, supported by strong cloud and AI demand. In Europe, Dublin and Frankfurt also saw moderate uplifts, while China lags with stagnant rents and weaker occupancy after a 2023 tenant default. Overall, Keppel DC REIT's long WALE and steady rental growth underscore its resilience and ability to sustain stable cash flows despite interest rate and FX headwinds. From 2021 to mid-2024, Keppel DC REIT kept gearing stable at 37%, well below the 50% MAS cap, leaving room for growth. Cost of debt rose from 1.9% to 3.6%, but 75 to 77% is fixed, protecting income from rate swings. Only 17% of debt matures in 2025, with an average tenor of 3.6 years, reducing refinancing risk. Overall, disciplined capital management and a staggered maturity profile help sustain distributions despite higher interest rates. This REIT offers opportunities and risks. It benefits from surging demand, a 7.7-year WALE, prime assets in Singapore, Europe, positive rental reversions, tax-transparent income appeal to yield seekers. Risks include China tenant default, higher debt, FX volatility, competition, and 50% gearing cap. Conclusion: a resilient player. T-Future success hinges on capital discipline and tenant diversification. If you found this useful, hit subscribe and comments below.